You're listening to Capital Topics, episode number 76. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investors. Your hosts for this podcast are James Parkyn and me, François Doyon, Rochelle, both portfolio managers with PWL Capital. In this episode, we'll discuss the history of market cycles with Raymond Kerzerho, PWL senior researcher. Enjoy! Good morning, James. How are you today?
I'm good, François. And how are you?
I'm very good, thank you. So, hello to you, Raymond. Welcome back to the podcast. It's a real pleasure to have you back.
Good morning, everyone.
So, we've invited Raymond to join our podcast today because he has recently published 2 blog posts covering the historical performance of stocks and bonds over the last 55 years. One of these blogs covers market cycles in nominal returns and the other one in real returns. These blogs are very interesting to us, so we felt that they would be of interest to you, our listeners. We thought once again that it would be fun to have Raymond, the author, to join us on the podcast to have him explain his findings. If our listeners are interested in reading these blog posts, they are available on the PWL Capital website in the Learn section. We'll also make sure to provide links to the blogs with this podcast for easy access. So, Ray, as I said earlier, welcome back. And I will go ahead with the first question. Like I mentioned in my intro, your blog post described the historical performance of stocks and bonds over the last 55 years. But what prompted you to write these blogs now, and why 2 separate blog posts on the same topic?
Yes, well, let's start with the purpose. Really, the idea is, especially with all the noise, with the trade barriers and all that are being raised with the United States, there's a lot of myopia and a lot of attention is given to short-term phenomenon in the stock market. My goal really with this article was to say, well, let's take a seat back a little bit and take a longer-term perspective on things. And really, actually, 55 years that I covered is pretty much the life of an investor.
Right.
So I thought it was an interesting perspective.
Mm-hmm.
On the second part of your question, why 2 blog posts? Well, in one of the blog posts, I covered the cycles of nominal returns. Nominal returns reflect the psychological experience that we have in investing in the market. Whereas in the second blog post, that is equally important, if not more, I touch on the real returns. So on all returns that are calculated and that I documented in the blog post, really what I've subtracted inflation to reflect the real value creation that's going on there.
Okay.
So, Ray, in preparing these blogs, as François has mentioned, you looked at 55 years of capital markets history, so starting in 1970. Can you please explain for our listeners why you decided on that 55-year period, and can you also explain your methodology?
Of course. So really, it's the 55 years. So the data starts in January or early 1970, and it ends at the end of 2024. So we have 55 years. It's not really something that I got up in the morning and say, oh, let's take 55 years. It's really because we have international data on a monthly basis only since 1970. We have international data dating back earlier, but it's only annual, or we will be limited to the U.S. stock market. I really wanted to mimic the experience of a Canadian investor who invests on a global basis.
Right.
So really, what we're looking at, I constructed the 5 portfolio, and what we're doing, once again, I'm focusing on the return data. So the 5 portfolios, I have one portfolio that is fully invested in stocks, and it's 30% Canadian stocks and 70% foreign stocks. Okay. So it's a portfolio that's very similar to VEQT, the ETF of Vanguard for the global equity portfolio. On the other hand, I have a fixed income portfolio that is basically 100% Canadian bonds. And then I added two more portfolios. There's one that is 40% stocks and 60% bonds. The other one is 60-40, and the last one was 80% stocks and 20% bonds.
Okay. So, Ray, your blog post discussed stock market cycles as a process that repeats over time. And you make the case that there are three phases to these cycles. Can you explain these cycles for listeners?
Yeah, absolutely. So really, when we're looking at the stock market cycle, what I did, I used an algorithm. So what the algorithm says, it says that the first phase of the cycle is the beginning of a bear market. A bear market starts when the market has reached its most recent all-time high and ends after a cumulative decline of 20% or more, and find a bottom.
Mm-hmm.
So that's the phase one. Second phase is the recovery portion. So the recovery, of course, the phase begins at the bottom of the bear market and concludes when the market returns to its previous all-time high. That's the second. So for all this recovery period, yes, you have in summary, you had a positive return, but you were just recovering from your losses.
You're just getting back to where you were.
Yeah, exactly. And finally, the third phase is the expansion phase, which begins when a recovery is complete and ends at the next peak, marking the start of a new bear market.
Okay.
So, Ray, one insight from your papers that I really like is that there are many ways to define market cycles. For our listeners, can you elaborate a bit on this?
Well, if you're trying to define what's a bear market or market cycle, you need to decide what type of data you're using. My choice was to use total return. So my data includes dividends and interest payments when I look at the returns of stocks and bonds. So that has an effect as dividend add to the return. And the other thing also is that I used monthly returns. So if we take like the polar opposite of what I have done, if we would have taken daily data, then and daily price data, excluding dividends, you would probably have found higher highs and lower lows because you have a much higher frequency in the data. So that's a different way to define that. As I wanted to document value creation, it was very important to, of course, to include the interest and dividends in the payment. Yeah, so basically, I gotta admit that in my study, by using monthly data and total return data, I tended to lowball a little bit the frequency of bear markets and how extreme they are.
Yeah, well, just an example is this past April where we had extreme volatility. But if you sort of looked at your portfolio at the end of March and then the end of April, and you ignored all the financial news, you were living, without any access to any financial media noise, you would have thought, hey, this wasn't a very volatile month, but that was actually intra-month very, very volatile.
There you go.
Yeah. Yeah, there's been quite a few market corrections over the year. And like James just mentioned, we just lived one in the US in April. Can you clarify for our listeners the difference between a market correction and a bear market?
Well, a market correction, I think most people in the industry would agree that that's a downward movement in stocks by at least 10%. And up to 20%. Past 20%, we're talking about a bear market. Mm-hmm. So that's another thing. But bear markets are not all equal. Some bear markets just stop shortly after reaching minus 20%. But then you've got severe bear markets. So in my study, the severe bear markets conduct to losses of more than 40%.
Okay.
So Ray, most investors, their experience dates from the 1990s or since then. But for some who are a bit older, a bit longer in the market, like your study covers the period since 1970. And in that period, minus 40% bear markets. I think we've only had a couple. In our last podcast, where we looked at the UBS, the yearbook with the Dimson Marsh Staunton data, that they really identified 4 big bear markets in the last 125 years, 2 of which have been since 2000. So think of the tech bubble bursting and then the global financial crisis. But so really, that's what most investors are really afraid of, is those big, deep, minus 40% or worse bear markets that last a long time. So based on your 55 years of data, do you agree with the UBS yearbook that there's really been 2 big, severe bear markets?
I would say that what I see in my data, first, there's really, once again, there's really light bear markets and severe bear markets. If I look at the past 55 years, there was the oil shock in 1973-74.
Mm-hmm.
That was very large downward movement in stocks. And the other part was really the tech crash into 2000. So it depends. If you look on a nominal basis, the tech crash and the financial crisis, they were 2 severe bear markets. Like the tech crashed, the market crashed, it recovered, just barely recovered, and then it crashed again in 2008. So if you consider it on a nominal basis, there was really 3 big bear markets, major bear markets in the last 55 years. I would like to add, in terms of what investors should expect, in my review, I found like an average 1.3 bear market per decade. So investors should expect at least 1 bear market in every 10 years.
Yeah, with most of them being in the minus 20, minus 25 range, right?
Yeah.
Okay.
And how long do they last? How long does a bear market last, Ray?
It's very volatile. There was 1 bear market that lasted only 3 months, like after the crash of 1987, and the recovery started shortly after. And other bear markets last, like the tech crash of 2000 last 2.5 years. So bear markets can be quite long and they can be very short. We really can't make our mind that, okay, it's been 6 months, we're going to be good now. It's really, we really cannot forecast how long a bear market is going to be.
And how much can an investor expect to lose in a bear market? Or historically, how much have they lost?
Yeah, so if you, I'll give you the nominal and the real numbers. The nominal numbers are, of course, a little bit less extreme. So for the oil shock of 73, it was minus 42%.
Okay.
And for the financial crisis, it was like minus 43%. So the difference between those 2 was quite thin. And it's the same thing. If you look at the real return, the oil shock was like minus 48%. It was like almost half of the portfolio value was deleted there. And then, so that's in real terms. That's because there was a lot of inflation back then.
Yeah.
But a similar story in the period from the tech crash to the end of the financial crisis, the total return net of inflation was like minus 47%.
Yeah, just to reassure our listeners here a bit, that's for 100% equity portfolio, isn't it?
Yeah, absolutely.
Okay.
We're talking about the all equity portfolio.
Yes, okay.
So Ray, in your research, what can you say about how long does it take to recover from a bear market on average?
Once again, it's very variable, but for sure it depends on the severity of the bear market that has preceded. Deep losses, of course, take longer to recover from. On a nominal basis, the longest recovery was 4 years following the financial crisis of 08-09. And you would have not made any money during the recovery. You've just recovered your losses.
Yeah. Mm-hmm. In fact, it's often referred to as a lost decade, because when you bookend the tech bubble and then the global financial crisis, at the peak, I believe the S&P 500 was at 1,522 in March of 2000, and it bottomed in March of 2009 at like in the 600s there. So you know, if you look at when your starting and end data points are, you can say, wow, there's a lost decade there.
Yeah, well, it was a lost decade for the U.S., but it wasn't the lost decade for Canadian
Very
equities.
good point you make, François. Absolutely agree. And that's where we're globally diversified for that very reason. So, Ray, we often tell our listeners that downside arithmetic is not the same as upside arithmetic. Just let me be more, you know, a little bit more clear about that. If the market drops by 20% and you're 100% equity, then, you know, to get back to where you were, your portfolio has to gain 25%. And obviously, if you have a deeper 40% large loss, it's an even bigger gain required because you only got 60 cents left to get back to $1. So what would you have to say about that?
Well, I agree with you 100%. And if you take more extreme examples, you lost for nearly 50% in the severe bear market. You need 100% return to recover from that. Yeah. However, there's really a silver lining to it, is that when you have a very bad period in the stock market, it tends to recover very, very strongly afterwards. So you can have a lost decade, but you're going to have a very strong recovery eventually.
And we can't, as we mentioned on our podcast, you can't guess when that turnaround is going to happen. And it's that early turnaround phase that really gives you that great long-term performance. So that's where time in the market is so much more important than try to time the market.
Yeah, just remembering the 2009, March 2009, when the market started recovering, boom, 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 a couple of days, and it was off, and you missing those first couple of days when the markets were positive was surely had an impact on someone's portfolio if they weren't invested. Next question, Ray, for you. How long do expansion phases last, and what are the returns? Or what were the returns?
Yes, as I was mentioning before, there's a lot of positive in all that. Even though bear market can be extremely difficult for investors, when you get into recovery and then the expansion, it can be very lucrative. Expansions can be zero, like after the crash of '87, there was really no expansion. We had just a recovery, then we fell back into another bear market. So that's one side of the story. The other side of the story is that you can have a recovery lasting 10 years or more. Inflation-adjusted compound return range between 0 and 154% that you can get in the recovery, and not in the expansion phase. So sometimes stocks return are depressing, but sometimes they are so high they appear to be too good to be true.
Mm-hmm. So, Ray, in your blog, you're often referring to the stock market as a money multiplying machine. Obviously, this is what all investors hope for. That's why they're prepared to accept the negative volatility or the deep bear markets or the less deep bear markets. And in the short term, and we spend a lot of time on our podcast, discussing investor psychology and good behavior and bad behavior. So in your blogs, you elaborate on both real returns as opposed to nominal returns. Can you clarify your findings for our listeners between real and nominal returns?
Yeah, well, I think the real important part is really here about value creation. And I've put a table in my second blog post on real returns, looking at the net wealth creation of $1 invested at the beginning of 1970, and then by decade. And what I found is that in some decade, you don't make money at all. Like the 70s, you were pretty much at the same place at the end of the decade than where you were at the beginning of the decade. But after that, when the market really turns around, there's a lot of value creation. So basically what I found is that over 55 years, when you average all these bad periods and extremely good periods, for the stock market, the all equity portfolio, $1 invested at the beginning of the period, multiplied by 16 times.
Okay, and that's the real return, right?
That's the real return. I'll give you a few other numbers. Even a 60-40 portfolio multiplied by 12 times.
Yeah.
The other one I'd like to mention is the all fixed income portfolio that multiplied by 6 times. But it's really important to note that the returns on bonds on Canadian bonds in that period were extremely positive. I wouldn't expect that type of number looking forward in the future. But the numbers on equity are quite realistic, I believe.
Right. Out of the 5 portfolios you've mentioned, Ray, in your study, which one of them appears to be the most stable over the course of the period?
So when you look at this table that I mentioned earlier by decade, what you'll find out is that the stock portfolio has lost money in at least one decade, and I was in the standstill over another decade and made quite a lot of money in the other decades, and also the 5-year period since 2020. If you look at the bond market, you also had a negative decade in the 70s.
In bonds.
But the portfolios, pardon me?
A negative decade in bonds.
Oh yeah, you can lose money over 10 years in bonds. Oh. Bonds are not as safe as people think because they're very exposed to the risk of inflation. In the 1970s, we had really a problem with inflation. But just to come to my main point, it's really the two balanced portfolios like this 40% equity, 60% fixed income, and the 60-40 portfolio both never lost money on a decade. And I'm talking about actual decades, the 1970s, the 80s, the 90s, so on and so forth. I don't see a decade where they lost money. Sometimes they did not make huge returns, but they made money in every decade.
I would add an interesting anecdote to your finding, Ray, is that clients have said to us, boy, I really get it, the benefit of a balanced portfolio this year that's globally diversified, because you see, for so long, for almost 15 years, the U.S. equity outperforms. And then this year, they had the stability of their bond acting as it should as a shock absorber. And they had, Canadian equity, which is close to break even, a little bit of return. And then they've had, international equity, which has done quite well. So in comparison, obviously, to the U.S. equity, which was down. So clients are seeing that. And in fact, I've seen data where, up until somewhere like in 2020, with a 64% equity, 40% bond portfolio, you'd get 85% of the all equity return with a fraction of the volatility. So that's really not a free lunch, but it certainly is perhaps the portfolio that people can stick with. And we did the podcast last year with Professor Cederberg's research, where he said you really have to look at the long-term real returns, and that supports the research you're sharing with us today, that you can get periods where bonds and on a real return basis are really going backwards. So you can't really assume that it's a safe bucket in real terms. So again, these are very important findings that are consistent with what other academics research is producing. So we as portfolio managers find that very helpful. So Ray, to conclude, can you highlight what are the most important lessons you draw from these 55 years of market data?
Of course. So really the first thing that I see in this data is do not interrupt the compounding by actively trading in your portfolio. If you're making active decisions, it just disrupts the process of compounding the returns on the portfolio. And this process is a little bit complex because it's not like compounding on a bond. You buy a bond and it compounds over 55 or a number of years. It's really you have to deal with the ups and downs of the stock market. So really trading in a portfolio, it really interrupts the compounding of returns. The other thing is to think long-term. Some people will maybe mock the idea of taking a multi-decade investment horizon, but it's really the way to achieve exceptional returns, in my view, and create a lot of wealth. Number 3 is really the early dollars are the most productive. The younger you are, the young people, they have a lot of more power than they think. And you start investing when you're young is making a decision to be rich later. To me, that's as clear as that. Another one really is that growing wealth requires a substantial allocation to equity. I've been reading recently the book from David Swenson, former manager of the Yale endowment, and he says exactly that. He says it's really the equity portion of the portfolio that generates a lot of wealth. The bonds are still important to provide some stability, but it's really the equity that are creating value. I've got a couple more. So it's really, there's really an opportunity as well. There's really periods that are tougher in the market and periods that are much more prosperous. Investors should consider to adjust their savings and spending patterns to portfolio performance. So the most important case is for retirees. You set yourself a budget of how much you can spend. Well, if you want to make sure not to outlive your money, the best thing to do is to adjust with the market a little bit. So if the market has a bad year, maybe try to spend a little less. And if the market is deliver very high returns, you can afford to spend a little more as well. So it's not, I don't want to give morale to people or something like that. The idea is it's mathematic. If you adapt to the market performance, you have a better odds of not outliving your portfolio. And the same thing for people who are saving. If you have very high returns for a period of time and you have at one point that much saving that you don't need to save that more to achieve your goals, maybe you can save a little less. And otherwise, if market returns are really terrible, you need to put a little more money aside for the future if you want to achieve your long-term goals. Last thing, investors should hold on their portfolio and expect bear markets as a normal part of investing. So it's really hold your portfolio, stick to your asset allocation, rebalance, and never bail out during crashes. Mm-hmm. Never do that. Your portfolio is there. You should think about your portfolio as a thing that is there for life. It's not a temporary thing. It's there for life.
Wow. Well, thank you, Ray. This was really insightful. I think we'll conclude our podcast here. And I think our regular listeners will agree that these lessons are exactly at the core of our investment philosophy, and that they will help them continue to focus on the long term and have an appreciation of the laws of risks and return. Again, as I said at the outset of this podcast, we'll make sure to put the links to Ray's blog post on the podcast page. On this, thank you, Ray, for your participation today. As usual, this was very interesting, and I hope our listeners have found it interesting as well.
My pleasure.
I remind our listeners that Raymond's blog post can be found on the PWL Capital website in the Learn section. Also, thank you, James, for your contribution again today.
My pleasure, François.
So that's it for episode number 76 of Capital Topics. Don't forget, if you'd like to submit a question or suggestion for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our expertise in managing your assets, you can reach us by clicking on the Contact Us button, which is located on the Capital Topics homepage and on all our publications. Furthermore, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in, and please join us for next episode to be released on July 16th. In the meantime, make sure to consult Capital Topics website for latest blog posts. See you soon, and thank you.